What are you doing to deal with some of these issues? Inflation, supply chain, labor disruption, technology investments. What decisions should you make? What actions should you be taking? That's what I want to be sharing with you in the next 45 minutes or so.
Joining me now, the owner of the Marks Group PC, certified public accountant, Gene Marks.
He's the best when it comes to this kind of stuff.
Hi, I'm Gene Marks. I cover the economy, politics, workplace issues, technology, all sorts of issues that affect businesses. I talk about actions and strategies and things that you need to do to run your business based on what the economy is.
You are responsible for your employees, for your customers, for your partners, for your family members. People rely on you for their livelihood. They are looking to you to make sure that you navigate your companies and your businesses successfully and profitably over the next few years.
The most important thing that people have in common that are running businesses is they don't have all the answers. Many of them are asked to wear multiple hats. My job is to provide my audience with as much information possible to help them run their businesses.
When you guys are walking out of here, though, I promise you, you will be walking out with 2 or 3 great ways, great ideas, great things to do to grow your businesses.
The big overarching theme of what I talk about is that smart business owners, smart leaders, smart managing partners of accounting firms, they're always looking ahead. I like to be your vessel. I am out there interviewing people all around the country, smarter people than me, that are running businesses, that are managing operations. I like to find out what they are doing to make their businesses as profitable as possible. Every week, I write for some well-known publications like The Guardian and The Hill and the Philadelphia Inquirer, the Washington Times, Forbes, and Entrepreneur magazine that cover issues that impact businesses.
All of these things are being done by business owners and smart leaders and managers to make sure they're controlling their costs.
You're going to get a very, very fast-paced, entertaining conversation about the things that are impacting your business and the actions that you need to take. This is such important information. I want to make sure it's sticking into your brains. You have got to make your passwords as complicated as possible, and the best way to do that is using one of these password management tools. The other thing that I like to say is I like to kind of sprinkle in a little humor in my presentations as well.
By the way, in a related story, that's Keith Richards, just so, right? Remember, always be looking ahead.
My job is to come to you as an audience member, somebody running a business, saying, this is what's going on, and this is what I think is going to happen over the next year or so, and here are some actions and strategies that you should be taking to help them run their businesses as profitably as possible.
True or false, you are much smarter than you were a mere 60 minutes ago. Yeah, that is true. So are you ready? We're ready to talk some taxes here. We're going to get you saving some money over this year. All right, let's do it. But before we do, let's talk a little data. Recently, Adobe did a large-scale survey of small businesses. These are businesses with less than 100 employees. Just so you know, 26% plan to file their tax returns online in the future. 37% expect to file tax returns online with the support of an accountant in the future. 53% have already digitized the process of filing their tax returns, while only 32% stored records or received digitally in 2019. 45% are expected to do so post-pandemic. Doing taxes, meeting with your accountant, is the number 2 dreaded task for small business owners and senior leaders, only ranking below making cold calls. Well, I'm going to make this task easier for you. Adobe is making this task easier for you by helping you digitize all of the receipts and documentation that you need to properly file your tax returns and make it that much more easier for experts and accountants to do that as well. But this presentation is designed to make it easier for you to talk to your accountant and at least bring up these issues that could save you money, both individually and in your business. So let's get to it, okay? First thing I want to talk to you about is COVID-related tax opportunities. Hopefully, as you're viewing it, COVID will be well behind in our rearview mirror, and that would be great news, I'm sure, for everybody. But that doesn't mean that there are certain forms of legislation that are out there that are still in effect for the next few years related to COVID that could really help you save taxes. So let me mention just a few for you to talk to your accountant about. The first is the Employee Retention Tax Credit. That is still in effect. And let me just explain to you the Employee Retention Tax Credit. It's basically the government giving you money to keep your employees employed. And that was a big thing during the pandemic. Now, you might not have been able to or thought about it or knew about this tax credit during 2020 and 2021 when all of this applied, but that's okay. You can still go and amend your payroll tax returns from 2020 or 2021 if you're eligible and get the money back. How much money? Well, if your business was affected by COVID in 2020 or 2021, last 3 quarters of 2020, first 3 quarters of 2021, if your business either was shut down or partially shut down, if you lost revenues because of COVID, in 2021, if you lost 20% of your revenues in any quarter compared to the same quarter back in 2019, all of those things or any of those things, you would be eligible for this credit. And the credit is huge. It's up to $7,000 per employee per quarter. This is 2021 for that quarter that you're eligible, which means if you got 10 employees and you're eligible, you could be saving $70,000 in your payroll taxes. Now, you might have already paid these payroll taxes in, but like I said earlier, you can go back and amend your payroll tax returns and get the money back. So here's my advice to you. And by the way, if you're applying for paycheck protection or you got, your forgiveness for it, that's okay. You can still get the employee retention tax credit as long as you're not using the same payroll dollars in the calculation. So here's what you do, okay? Talk to your accountant or talk to your payroll service. Ask them, say, listen, can we check to make sure that I wasn't eligible for this credit anytime in 2020 or 2021? Did I lose revenues? Was I shut down or partially shut down because of COVID? Can we revisit that? Because if I was eligible, then we can go back and amend our return from that quarter, and I can the government will give me the money back from the payroll taxes that I paid based on that credit, okay? So that's the first thing, employee retention tax credit. The second is the work opportunity tax credit. Now, this has been around for a number of years, but it was extended to 2025. This is your opportunity to let the government pay hiring bonuses to new employees. That's what the work opportunity tax credit is. It was extended through 2025. It applies to the hiring of veterans, the long-term unemployed, welfare recipients, and others. It's anywhere from $1,200 to $9,600 per employee. And let me explain to you how this works. When you're looking to hire a new person, if they're a veteran, if they are off of welfare, or if they've been unemployed for more than 6 months, maybe that rings a bell, stop. Call your accountant. Say to your accountant, hey, I'm going to hire this person. We're going to pay him $50,000 a year. What's my work opportunity tax credit? The person's out of the military or they've been unemployed for 6 months. Your accountant will do the math for you and say, hey, listen, based on the salary, you'll get a $5,000 credit against your taxes this year. You hang up the phone, you go back to that prospective employee and you say, hey, listen, come and work for us, and if everything's good after, a month or two, we'll give you a $3,000 hiring bonus. You still are ahead $2,000, but here you've been able to pay them a hiring bonus to come and work for you, and the government pays you to do that, okay? So look into the work opportunity tax credit. It's for every new hire that you make between now and 2025, so it really, really will apply. That's the second COVID thing. The third COVID thing has to do with net operating losses. Now, this applies for either the years 2020, 2019, or 2018. Thanks to prior tax legislation, if you lost money in a year, you're not allowed to carry it back anymore. You can't carry it back against years where you made money and then get the money back in taxes that you paid. That's not allowed after 2017. But because of COVID, there's new legislation that will allow you to take these losses from 2020, 2019, or 2018. Doesn't matter why you lost the money. This is nobody cares. You can take the money and carry it back. Carry it back up to 5 years. So you can carry it back to a year where you did make money, amend your return, whatever taxes you paid in that year, if you've applied a loss against it, you'll get the money back from the government. So talk to your accountant as well. There's big delays at the IRS, so make sure you file as soon as possible. It'll take a while to get there. It could take 3 to 6 months. But if you lost money in any of these 3 years that I've got up here, talk to your accountant now. Go back and amend those returns. Carry those losses back to prior years and get the money in your bank account, all right? Am I saving you money already, right? We've got all those COVID things. Don't know if you're aware about them or not, but this is money in your pocket if you're eligible. So take a look at those 3 things. So COVID opportunities, the employee retention tax credit, the work opportunity tax credit, net operating loss carrybacks. Those are three big things that you can apply for your business to get money back on taxes that you paid. Take advantage of it now. Should we do some more? Because there's a lot more, okay? Next has to do with your compensation. Let me give you some tips about minimizing your taxes when it comes to your compensation, okay? The first has to do whether or not you own a pass-through organization. Now, a pass-through organization is like an S-Corp or a partnership, right? Pass-through means that you make the money at your company, and whatever income that your company made passes through to your individual return. Now, one of the great benefits of a pass-through corporation is you can have a little bit of flexibility with your compensation. Now, you don't want to underpay yourself, but you want to pay yourself a reasonable salary from your company, and really do it based on, go to Indeed or Career Builder, get some salary comparisons in your area for a business owner in your industry, in your geographic area. Pay yourself at the lower end of that. Because whenever you pay yourself in salary, that's going to be subject to employment taxes, right, and payroll taxes. So fair enough, right? However, you can minimize that compensation to minimize your payroll taxes. If you want more money, you can just take it out as a draw. And that way, that money itself isn't getting taxed at your company level, and you don't have to pay payroll taxes on that. Now, again, whatever money your pass-through makes ultimately comes down to your return, and you pay taxes there. But you can avoid some payroll taxes that way if you've got more flexibility in what you actually call compensation for yourself. So that's a good thing if you're a pass-through owner, okay? Number two, hire your kids. This applies to any company what you have, okay? You can pay up to $12,100 per year. That's the standard deduction. I think it might have gone up a little bit actually, but it's around $12,000. If you pay your kids up to $12,000, they come and work for you part-time over the holidays or during the summer, they don't get taxed on it other than payroll taxes, but it's a small amount. You get a deduction for it. And by the way, this applies for any kids. I mean, it doesn't necessarily have to be related to you. It could be your employees' kids. Nepotism is fine in this situation. And, if you're going to hire a kid, you're not going to put your 6-year-old behind the receptionist desk. It has to be like a reasonable age. But if you've got a middle school kid, a high school kid, you want them to make a few extra bucks, pay them. They can take that compensation and they will not pay taxes on it other than a little payroll tax. You get a deduction for doing that. By the way, after you pay them, take the check, put it in a savings account for them, okay? Because they're going to blow it on something stupid. So again, pass-through compensation is flexible. Hiring your own kids is another way that you can get a good deduction and also keep your kids employed. A few other things. The home office deduction, okay? So, you must be a principal at your place of business so that, you can get it. If you're an employee working from home, just be aware that the home office deduction is not going to really apply to you. A lot of people think like, wow, I've been working from home all this time through COVID, I can get a tax deduction for it. You really can't. It's for a business. It's for if you're running a business. If you file a Schedule C, or a sole proprietor return, or an S corporation if you have it, or a partnership. You can take deductions from your home. You can either base it as a percentage of your actual costs, or you can use the simplified method, which is just $5 per square foot up to 300 square feet, but you can get a deduction for doing that. Just be aware, it's got to be an exclusive and regular place. It's got to be your principal place of business. It can't be like your bedroom, we have a desk in there. It's got to really be segregated if you really want to take advantage of this deduction. But this is something that might apply to you, particularly if you're a freelancer, independent contractor. It's another deduction that you can take on your taxes to save a little money, okay? Let's talk about property. Let's talk about your assets. If you're a business owner, for goodness sake, take a look at your balance sheet. I know that we as business owners are very optimistic people. I know that you have got receivables on your books that are probably older than they should be. I know this because you've gotten promises from customers that say they're going to pay their receivables, pay what they owe you. A lot of people, as we know, anybody running a business, you sometimes come across those deadbeats, okay? So any receivables that you have that are over 90 days old or maybe 120 days old, write them off, okay? Take them off your books. It's a lost sale. I don't know, track it on a spreadsheet somewhere. Maybe the heavens will open and money will come raining down by some miracle, but it's unlikely you're going to connect it. So write it off your books because you can't get a tax deduction for it unless you write it off. So, suck it up, get rid of it, take that tax deduction, and then move on, right? Same thing with inventory, because I know you as well. You probably have inventory in your warehouse or somewhere in your business, stuff that you might have bought years ago. You got it at an auction. It was a great deal. It was a competitor that went out of business, and it was like, wow, I can't believe this is fantastic. And it's still sitting there. And it's been 6 or 7 years later. Nobody's done anything with it. It's gathering dust. There's like rabbits that are nesting behind it, Get rid of it. Okay, old inventory costs you money. It takes up space, it incurs overhead because of that, and it costs you taxes. If you've got inventory in your books and it hasn't moved in a year or 2 years, that's also a really long time, write it off. And when I mean writing it off, you got to pick it up and dispose of it. It's got to leave your place, get rid of it, trash it. Maybe you can salvage it, sell it for something, but get it off your books. That way you could take a tax deduction. Okay, so write off your old receivables and your inventory. Capital equipment. The Section 179 deduction is still very much in effect. As a business owner, this year, you can buy capital equipment and up to about $1.1 million, you can take a full deduction for it by accelerating depreciation in the first year that you buy it. Couple of comments on this. The capital equipment can be computers, can be software. It could also be equipment, and machinery as well. So, and some forms of property. So that are depreciable. All of that stuff falls under Section 179. Number two, in an era of inflation that we're in right now, we are telling our clients, if you've got money to invest, buy inventory and buy equipment, because those types of investments, those assets, they tend to keep up with inflationary times. So buy equipment. You will see the market value keep up and you'll get a deduction for it. Number three, you don't have to pay for that equipment when you first buy it. You can finance it. You can get a loan from the Small Business Administration, or you can find some other form of financing. As long as you put it into service, you plug it in before the end of the year, you get the full deduction. So I have some clients that will buy a piece of capital equipment in the fourth quarter of the year. They'll finance it. They don't start paying it until the next year, but they get it up and running this year. They take the full deduction in the year that they have to put it into service. So keep that in mind when you're considering capital equipment. And also, if you have disabled people in your business and you want to give them access, and you have revenues with less than 1 million people and no more than 30 employees, you can get a credit for a tax credit for putting in disabled ramps and other access, for disabled people into your business. So that's a great accommodation, of course, for your customers and for your employees, and the government will give you a $5,000 tax credit for doing that as well. So we talked about opportunities under COVID to save money on taxes. We talked about opportunities from compensation to save money on your taxes. Pay yourself less, assuming you're a pass-through, and it's reasonable salary. Hire your kids, right up to $12,000. Pay them, get the deduction for it. They don't pay any taxes other than little payroll taxes. Take a home office deduction if you are an independent person, a freelancer, side gig, whatever, and it's a specific separate place. You can do actual expenses, or you can use the simplified method. And when it comes to property, write off your accounts receivable, write off your inventory if you're not using it, buy capital equipment and put it into service. You get the full deduction for it, or get credit for, and if you have disabled people and you spend some money to make access better for disabled people, customers and employees, you'll get up to a $5,000 tax credit just for doing so. We good so far? I'm saving you some money, right? You got some things to talk about with your accountant so far? We got some more stuff for you as well. Let's talk about your employees. Now, the government makes it helpful for you. Remember I talked about the work opportunity tax credit, right? It's like, hey, I can use this tax credit and use it to pay hiring bonuses. And in this time of, super competition for good talent, we have a labor supply, shortage, that could make the difference to hiring good employees. And the government is doing that for you. Well, the government offers other deductions and credits to also help you compensate your employees as well. So you need to be aware of these. So for starters, there's dependent care. You can take a deduction of up to $5,000 a year per employee if you are helping them with dependent care expenses. That's child care as well as any dependent care, like their older relatives in their family, parents and grandparents. You have to have a formal plan with rules. You can't favor, your owners or spouses or dependents or, all that. But at the same thing, you can also have, the ability to have, a benefit. And again, you don't have to pay them $5,000. You can pay them. You say, we'll reimburse you $1,000 a year, but the government will let you pay up to $5,000 per employee if you want to do that. You get a tax deduction. They do not get taxed on that. If you really want to go extensively, you can build out your own dependent care facility. You can build out a child care facility. If you do that, you can get a tax credit of up to 25% of your costs, or up to $150,000. So I have some clients that are in a certain neighborhood, or they're in a Main Street district, and they rent out some space and build out childcare for all of their employees to share. And then they split the costs of it, and they get a big tax credit for doing that as well. So if childcare or dependent care is important to you and your employees, and maybe you've got some other people in your area that it's important to them as well, you can have a facility that you can share the costs of investment, and then get a tax credit for doing that as well. It's a big help. That is a big help. Number 3, you can start a dependent care flexible spending account. The employees, if you set this up, can contribute up to $5,000 to it out of their salaries, which means that it's pre-tax. And then they can pull the money out to pay for their dependent care expense. They have to use it all by the end of the year. But just think about this, okay, for a minute. You have an employee that puts money away for their dependent care. Say it's $5,000. It's pre-tax, so they save on their taxes. Then they pull it out to pay for their dependent care expenses. Then they submit it back to you. You can reimburse them for their dependent care expenses. All this time, they're not being taxed on that money, and you also get a deduction for doing that too. So you have a lot of options when it comes to dealing with dependent care in your business and providing a great benefit for your employees. I mean, think, half of our employees in this country are millennials and Gen Zers. These are people having kids, and young kids. And these are 2-earner families. It's a lot for young people. So this is something that an employer can do to really help them out. You can also pay for education. If employees want to go and take courses outside of the business, and it doesn't even have to be business related. If they want to learn how to fly a plane or bake a cake, you can reimburse them up to $5,250 a year for educational expenses. They do not get taxed on it. You get a deduction for doing this. Again, it's got to be available to all your employees as part of a plan, but what a great benefit to apply. And again, it doesn't have to be that full amount. It can be $1,000, but it's a great benefit to offer. In addition, while I'm thinking about it, not just for education, but also student loans. So, and I got to mention this next time that I do this presentation, but because of COVID through 2025, you can pay $5,250 per employee to pay down their student loans. They don't get taxed on it. You can take a deduction for doing that. And again, that expires in 2025, but it's another benefit. Either education or helping them pay their student debt is another great benefit you can provide, and the government will give you help doing that, okay? Also, if you have some employees that need, they're looking to adopt kids, you can reimburse them adoption expenses up to $13,570. There is a phase out that begins at this level of income, but you can make that available to them. Again, it doesn't have to be the full amount, but it's another benefit to provide. I don't know what percentage of people are looking to adopt kids. I don't think it's a significant percentage, so it's a nice thing to offer for those that are doing it, and it looks good from a cultural standpoint, and the government will give you a deduction for doing it, and they will not get taxed on doing that as well, okay? While we're still on the subject of your employees, let's talk a little health care and retirement stuff, okay? On the health care side, I am seeing across the country with my clients offering health savings accounts, or HSAs. They need to be combined with a high deductible plan, which is what most of us as small business owners do. HSAs are hugely popular. With an HSA, employees can put money away pre-tax, or you can do the same. They can pull it out without any tax liability and use it to pay for any unreimbursed medical costs that they might have occurred, okay? Not only that, with HSAs, the amounts roll over to the next year if they're not used. So it's not like a flexible spending account where you got to use it that year. People like that. Also with HSAs, if an employee leaves you, they can take the money with them. People like that. So it's a good benefit to offer. Be aware with HSAs, they're like a 401k account. I mean, their discrimination tests apply. People can determine where their HSA money gets invested in, like different accounts. So you can set it up in that way, but it's just another way to help your employees save money on their health care that really doesn't cost you very much at all to get an HSA set up. You absolutely should be considering it. The other is an HRA. These are health reimbursement accounts. Now, these were not really acceptable under Obamacare going all the way back to 2010, but the Trump administration had a bunch of executive orders when President Trump became president, and a lot of them were overturned by the Biden administration, except for this one. HRAs, health reimbursement accounts, are still okay to set up. And let me just make sure that you're aware of what this are, because this is what my clients are doing. They're getting out of the healthcare business. They're getting rid of their group insurance plans, and they're basically saying, listen, whatever we were paying for our health care for you, okay, we're going to put the money in an HRA account for you. You don't get taxed on it, the employee. Me as an employer, I get a deduction for it. But more importantly, you can take that money and you can use it to buy whatever health care you want. Go on the Obamacare exchanges. Go on and talk to your own broker, whatever you want to do. But as long as you're eligible and as long as you attest that you're using it for your health care expenses, then peace be with you. And this way, I, as the employer, stay out of the whole health care arrangement. Now, you can have a group insurance plan and offer an HRA as well, but it's another way to save money on taxes for your employees. And again, you get a deduction for doing that. That's on the health care side. On the retirement side, the Secure Act of 2019 introduced some new changes to 401k accounts. If you don't have a 401k plan in your business and you have less than 100 employees, set one up. The government will reimburse you up to $15,000 for the cost of setting up a 401k plan. It's crazy not to do that. If you have a 401k plan or a SEP plan or a simple 401k plan, and if you make a small change to it and say that automatic enrollment is required, meaning any new employees are automatically enrolled in the plan, they can always opt out. But if you just put that stipulation in, the government will give you a tax credit for doing just that as well, $500 a year for 3 years. So make some changes to your 401k plans. Talk to your benefits people as well, and take advantage of that tax credit. By the way, just to make sure we're clear on our 401k plans, because we are talking taxes here, you, an individual and their company can contribute up to $61,000 in 2022, $20,500 per individual. So that's a lot of money you could be putting away completely pre-tax. Be aware that that's just for setting up the 401k plan. By changing automatic enrollment, you get that $500 3-year credit for doing that, okay? If you set up a personal IRA, and you may qualify for both, you can talk to your accountant about the rules. You could put away potentially another $6,000. If you are a very small business and you just want to set up a SEP IRA, again, it's $61,000, although it's up to $290,000 in compensation. So all of these deductions are available for you under retirement plans that you as a business owner should be taking advantage of. They're pre-tax plans. There are after-tax plans that you should be considering for your employees as well. There's a Roth IRA and a 529 plan. If you set this up for your employees, you and them can put money away, but it's after tax. They've already been taxed on it, but then it grows tax-free. And then you can take it out without any tax consequences if you meet certain of the rules. For example, if you set up a 529 plan for your company, that's for education expenses. Your employees can put money away tax-free. It grows tax-free, and then they can pull the money out without any tax consequences, but as long as it's used for higher education, like college, private school, religious school, and any related expenses to it. So it's a great benefit to offer. And okay, it's not saving them taxes initially, but it saves them taxes on the growth of the assets over time. It's a great benefit, and that's something else that the government is allowing us to do. So don't just consider the pre-tax plans, also consider the after-tax plans when it comes to retirement and putting money away. This kind of stuff is really helpful, both to you and to your employees.